Hi everyone, I welcome you all to my channel Dash Royal, and today we are going to talk about IPO or Initial Public Offering. In this topic I am going to cover what is an IPO, how do companies offer IPO, why do companies offer IPO, should we invest in IPO, things that we should know before investing in an IPO. So let's get started. What is an IPO? IPO means Initial Public Offering. An IPO refers to the process of offering shares of a private corporation to a public in a new stock issuance. It is the process by which a privately held company becomes a publicly traded company by offering its shares to the public for the first time. A private company that has a handful of shareholders shares the ownership by going public by trading its shares. The company gets its name listed on the stock exchange through the IPO. Now, how do companies offer IPO? Prior to an IPO, a company is considered a private company. As a private company, the business has grown with a relatively small number of shareholders, including early investors like the founders, family and friends, along with professional investors such as venture capitalists or angel capitalists. A company, before it becomes public, hires an investment bank to handle the IPO. The investment bank and the company work out the financial details of the IPO in the underwriting agreement. Later, along with the underwriting agreement, they file the registration statement with Securities and Exchange Commission. The SEC scrutinizes the disclosed information, and if found right, it allows a date to announce the IPO. Why do companies offer IPO? Offering an IPO is basically a money-making exercise. Every company needs money to run its business. It may be to expand the organization, to improve their businesses, to support the infrastructure, to repay existing loans, etc. Trade stocks in the open market means increased liquidity. A company, by going public, means that the brand has gained enough success to get its name listed in the stock exchange. It is a matter of credibility and great pride to any company or organization to be listed in the stock exchange. In a demanding market, a public company can always issue more stocks. This will pave the way to acquisitions and mergers, as the stocks can be issued as a part of the deal. Let us now talk about the types of IPO. Fixed price offering. Fixed price offering is pretty straightforward. The company announces the price of the initial public offering in advance. So when you subscribe in a fixed price initial public offering, you agree to pay in full. Next is a book building offering. In a book building offering, the stock price is offered in a 20% band, and interested investors place their bid. The lower level of the price band is called as the floor price, and the upper limit is called as the cap price. Investors bid for the number of shares and the price they want to pay for that particular share. It allows the company to test interest for the initial public offering among investors before the final price is declared to the public. Now, should you invest in an IPO? That's a question that comes to everyone's mind. Deciding whether to put your money into an IPO of a relatively new company is indeed tricky. You just should not blindly invest in an IPO just because a new IPO is launched or your friend has invested in it. You need to do a little bit of research on the company whose IPO you are interested to purchase. The company obviously does not have enough historical data to back your decision because it is just going public for the first time. The red herring is the data on the IPO details which is provided by the prospectus. You need to scrutinize it well. Know about the fundamentals of the company, fund management team and their plans for IPO generated for fund utilization. The things that you should know before investing in an IPO. If you have bought an IPO for the company, you are exposed to the fortunes of that company. You bear a direct impact on its successes and loss. It is this asset of your portfolio which has the highest potential to reward the returns. Remember, stocks are subject to the volatility of the market. There is also the chances that you may lose your investment if the company does not do well in the future. You should know that a company which offers its shares to the public is not indebted to reimburse the capital to the public investors. And you should weigh up your potential risks and rewards before investing in an IPO. You should have a detailed and thorough understanding of the company's businesses that it invests in. If you are a new investor, I would suggest you to reach out to your financial advisor before taking any step. Thank you. And if you do like this video, do share and subscribe. Thank you for watching.